You had your earnings out on Monday. The stock is up on the news. You reported a lot of good news across the board. But let me tell you, here at Bloomberg, every quarter we spend a lot of time trying to figure out the differences and the similarities among the big banks. You're certainly one of those big banks. But give me your perspective on how Bank of America stood apart from the others on this earnings.
Well, David, good to see you again. Simply put, the organic growth engine that our company represents, that we were before the pandemic, has fully kicked back in. So we had a growth in what they call PP&R, profit before the provision expense. We had a growth in revenue. We had a decline in expenses. We had operating leverage. And I think that's, whether not comparing to other companies, but that's why the market reacted favorably to our earnings, is we have more customers doing more with us and making more money doing it, and doing it the right way. Earnings were down a bit, but that was really investment banking fees, and some of the market-based businesses were a little more challenged in the first quarter because underwriting stopped.
So, Brian, one of the reasons, there are a lot, but one of the reasons we love talking with you is because Bank of America and you really have access to an awful lot of the U.S. economy, whether it's individuals or it's small companies, medium-sized companies, big companies. And you have a real sense of where the economy is. And the one riddle that I have is you reported, for example, the consumer's doing really well. Your credit cards are up. Lots of things are up from the consumer. It sounds like the economy is doing well. But we have a lot of concern about a possible recession. Even Bank of America, you did a survey of fund managers that said that was their biggest concern, was a possible recession. Economists are saying that. How can you square those two things? Why are people concerned about recession when you see strength in the economy?
So let's separate two pieces out. Number one, our core estimate for GDP growth for the United States by Candace Browning-Platt and our research team, which is one of the best in the business, is 3.3% for 22 and 1.8% for next year. And that includes significant rate rises by the Fed. And so there's a belief there that the Fed gets it right, that they have a soft landing to engineer a return to trend growth, as the saying would go. The reality is there's debate around that. And will they have to engineer a harder landing just because the amount of inflation in the system has to be pulled back? But going to the second point, what is different this time than, say, the last rate cycle where they moved up in the 18-19 range, is even though unemployment's down, and it's down, at that point in 19, wages weren't growing as fast. Wages are growing very fast. At that point, customers had money in their accounts, but not like they have today because of all the stimulus dollars. And at that point, frankly, businesses were at the long end of a major recovery, 10-year recovery, one of the longest ever, if we remember talking about it before the pandemic. So the thing was sort of long in the tooth. Now it's almost like a restart due to the fact that you had the pandemic, the pullback, business closures, and you're coming back out of a ton of stimulus. So that's the two ways to think about it. So there's going to be a tug of war and there's a little tension, but as the market says, don't fight the Fed. And as I said yesterday, I wouldn't fight the American consumer, because what we see in our customer base, that I'm happy to talk more about, David, if you want, is tremendous customer activity by the Bank of America customers, which are 50 million strong.
Well, that's exactly what I'd like to talk about, and that is what you're hearing from your customers. As I say, you get to talk to a really wide range of customers. Are they concerned about the possibility of recession?
Customers, as you said, the people who manage money for a living are always worried about a recession. Our economists always have the recession probability of 15-20% at all times in the next 12 months, because things can go wrong. But what's on people's minds obviously is obviously there's a major war going on in Ukraine and a major humanitarian issue, that how the world will react to that, how that will back not just necessarily Russia exposure, which is limited for our company, but how it backs into the European economy and whether the European economy can continue to grow, and then how that affects the world economies. That's a worry. The inflation worry in the United States, and will the Fed get it right? Then the supply chain. We've been talking about this for a good while, but the supply chain is continuing to ebb and flow, and you saw some of that in China's announcements. That's more on the business side. But when you go to the consumers, it's not what they talk about. People survey them and they say, this is what I'm worried about. The question is, what are they doing? And in the month of March, they spent about, fairly stated, 13% more money out of their accounts and with their checks, with their Zelle, with their credit cards and debit cards than they did last March. When you think about April so far, it's up 18%. Those are numbers that square with a very strong economic activity level. And so what are consumers spending on? They're spending some more on fuel, but that's not, for the broad base of consumers, that's a more modest impact. For lower income, it has a higher impact, and that's one of the issues we have to deal with in society. But what they're spending on travel, entertainment, restaurants, they're moving around again at levels they haven't as we got through another wave in the Omicron virus. And so there's another worry is what happens with the pandemic. So consumers are spending a lot more. But the most interesting part is we look in the accounts of our consumers and say, what do they have? And a consumer with $1,000 to $2,000 before the pandemic, average in their account, now has $7,000 in account. A consumer with $2,000 to $5,000, $3,000 to $5,000 before the pandemic now has $13,000 in their accounts. Cleared average balances. And so they have more money to spend, and they aren't borrowing on their lines. The credit card balance is still $20 billion off. All that says there's a lot of dry powder on the consumer side. So that's the tension. So that's the good news. I don't know what they say and worry about, but I can tell you on a given day, they're spending money and engaging in the economy.
Brian, let's go below those numbers just in this step. You did a report for Bank of America that went into how those numbers were distributed in terms of what they're using their credit cards for. And the thing that struck me is, as I understand the numbers, that actually there was a 33% growth actually recently in the people making $50,000 a year or less. So it seemed to be skewed, if anything, toward people with less income.
And that's because if you think last year, about in March, there was another stimulus payment, and that was on top of a stimulus payment in the early part of the year. And so you've seen these stimulus payments come through to Americans. And remember, as they went through different renditions, they were geared more to people with lower incomes, as reported on tax returns. So they went to the lower-income households. And then on top of that, you had the tax credit, the child care tax credits and things. So that's been a good supplement in a state-level program. So that's what you're seeing. And so those households are in better shape than they traditionally would be when you're worried about a recession, because they have money in accounts, they have cash flow is stronger because they're getting paid more. Unemployment's basically at an all-time low if you really sort it out and think about it. The number of new claims on a weekly basis are the same number of claims as they were in the 60s. In the 60s, there was half as many people working. So it's actually half as much if you think about how strong the 60s were in the late part of the 60s. So, this is a very strong labor market. It's full employment, and the number one issue of businesses is, can I get workers? So that's going to bode well for people getting paid more of all levels. So I think this all helps, and this is what people were worried about in 18-19 when the Fed went in, is we're not seeing the wage growth, we're not seeing the lower income households benefit. That's changed a lot in this one, and we'll see what plays out, but it's a much different place to start from.
So the very strong labor market. What about the housing market? Because I saw that in your first quarter returns, you actually were down a little bit in residential mortgages. Should we be concerned about that, particularly as rates go up? I suppose people are less likely to borrow money to buy a house.
As rates go up, obviously the cost of a mortgage goes up. If you take a $200,000 mortgage and rates go up, 1% is $2,000 more a year divided by 12. You could do the math, and so it affects affordability. But the reality is people sort of make a mistake in thinking about the refi market as being a major contributor to the economy. It happens. It helps. People get a little lower payments. That's good because they have more cash flow. What drives the housing economy is construction. And if you just look at the housing numbers this week, there's still a lot of starts going on. There's still a lot of demand in housing. We still have a built housing shortage, both in the multifamily and the single family in many areas. When we look with our CEO colleagues in Charlotte, we see tens of thousands of units of workforce housing need to be built. When we look with our CEO colleagues in Boston, we see the same thing. They see the same thing in New York. So there's a lot of demand for housing because of just the natural way things are working, and that will hold the housing market up. Now, was it growing pretty fast price-wise? Yes. Will that slow down? Potentially, yes. But remember, it's growing at 3 or 4 times the normal rate it usually grows at. So I think everything ebbs and flows, and that's what the Fed will try to work on cooling down with the rate hikes. But remember, the underlying economic activity is building those houses, and that still has a lot of room to go.
You mentioned earlier the issue of inflation on your customers' minds. Let's talk about inflation. How are you seeing that expressed in economic activity? I mean, it can express itself in compressed margin ratios for companies, for example, even in demand destruction, people buying less things. Are you seeing that?
We're not seeing people buy less things yet because, frankly, because of some of the shortages, any price is fine, so they're willing to pay the price. So the transaction volume of our customers' activity is going up 7-8%. The dollar volume is going up higher, and that means some of that's just price increases. So corporate world is making good profits. They're passing through when they can, and you're seeing that in some of the corporate earnings. It'll be a very interesting earnings season. But the reality, they're handling the shortages and they're handling the inflation. It can't go on forever that way, and that's why the Fed has a job to bring the inflation back in line, because that kind of spiral is not healthy. But it takes rapid movement to get more efficient and rapid movement to move price, and then with more wages, people can pay the prices and do the things.
So when you're talking about your corporate clients particularly, are you seeing much wage pressure and therefore margin compression? Are they concerned about that?
They're all concerned about getting workers more than they are about the price, because they've all raised wages dramatically over the last 24 months. So to get the workers off the sidelines, and you're starting to see that come true. You're starting to see just in the last, our economist Martin was telling me that basically the number of people who quote early retired have largely come back in the system. So you're starting to see the people come back to the wage force. Participation rate has to go back up, but it's really, can I get workers? It's not the price, because people feel the shortage of workers is a shortage of products. A shortage of products is a shortage of sales, and they're out trying to get them. And those people in the services business, it's even more acute.
Brian, you mentioned earlier the anticipation that the Fed is going to be raising rates. They pretty much said they're going to do that. We heard from the Chicago Fed President Charles Evans yesterday at the Economic Club of New York, and one of the things he talked about was how far he thinks they're going to have to go. This is part of what he had to say.
Probably we are going beyond neutral. I mean, that's my expectation. When I see that taking out special factors, I'm still left with 3 to 3.5% inflation. That's not what we want. If the 2.5% inflation rate, I think we have more things to ponder there.
So, Brian, he's saying that he expects, at least, that the Fed will go above the neutral rate. Does that make sense to you? And by the way, do we know where the neutral rate is?
Well, I think our economists, likewise, going back almost 2 months ago now, put a pretty aggressive, I think at the time they said 7 rate increases, 7 quarter-point rate increases this year, and people were like, that can't happen, and all of a sudden the market moved with them. So, our people are pretty thinking they got to move pretty hard, quickly, and they have the license to do it, because they're talking about 350 basis point hikes at the next 3 meetings and things like that. So Ethan Harris and team are better to give you the exact estimates, but the reality is, if you even listen to the Chair Powell and others, and just like the president there, the idea is they're going to have to move past, because the inflation is much higher than what they were dealing with in 19, where it was barely getting the target level. Now it's clearly through it, and so they'll move past it, but they'll bring it back down. I mean, people forget they'll come up and come down if they have to. It's not like they just sit there and wait it out. So yes, they're going to have to move higher than what people may feel a short-term rate is what the economists believe, and I think the data shows it.
Yeah, so with the move from the Fed, obviously we're seeing actually the negative real yield actually flirt with positive, believe it or not, back up to positive real yield. Assuming that happens, which seems to be where the Fed is heading, what does that do for your business? Well,
the question is, if it's done the right way and it's going up for the right reasons, and you don't have a deep recession on the other side, banking makes more money, because the flip of that real yield is we have been effectively subsidizing our customers because of what we call the zero floors. So what are the zero floors? When real rates go below zero, we can't give a consumer less than zero in their account, so we stop at zero. That squeezes our margins. As the rates go back up, we have it. And the way to think about that, David, is when they went from 2 to 2.5 target rate last cycle, just at that very end of the cycle, in those 12-month period, our deposits grew 5%, and our maximum rate paid was around 100 basis points or 80 basis points or something like that. Why is that true? Because the checking balances at zero don't go up, and that's why it's good for our bank, is because we've basically been at a floor, which is, basically been subsidizing the customers for many years. And frankly, remember, I've been CEO since 2010, and most of my career is in a zero-rate environment. It was just a short period of time where it moved, and it went right back down with the pandemic. But the reality is we'll make more money, and we told people what those estimates were for NII, $600+ million next quarter, and then grows from there. And we have $2 trillion in deposits, and they're very stable, and it'll be very good for our bank, given that it's done in a way that doesn't create a deep recession on the other side.
$2 trillion in deposits, really important. Last time I checked, I think Bank of America is the largest dollar deposit taker in the world. Do you have to pay more for those deposits in a world where you're going into positive real yields and the rates are going up? And it's been a long time since we actually bought CDs and we thought we'd make some money off of them.
Well, and that's what happens. So the more rate-sensitive product goes up, but the reality is 40% of those $2 trillion are non-interest bearing. So zero is zero in any environment. And the only question is, will people pull money out of the accounts? It didn't happen last time. They actually grew during the repricing cycle. We grew all through it, and even during the Fed balance sheet being leveled off and came down a little bit. Now, this is different. There's just a lot more liquidity in the system, and we'll see it. And money will go into markets if the returns are better and it's short-term term, medium term, Treasury rates go up and money market funds become more attractive. But we have those products too. So we place our customers where they get the best deal. But what drives our deposit base is the huge, non-interest bearing checking accounts, 35 million checking accounts. We have 5 million more digital customers than we did in 19, to give you a sense. And I think we have 3 million more checking customers than we did in 19. And those customers, that money is money in motion, stays with us and stays low price. In our middle market banking stuff, it's similar, little different mix type of debate, but it's a similar thing. Their operating accounts, meaning that is the money that's in motion, those companies. So we have a lot of customers with their operating accounts. Therefore, we're a lot less sensitive. The highest we got last time, I think, was 80 basis points.
Brian, you mentioned earlier this horrific war going on over in Ukraine. All of us, I think, are horrified by what we're watching. I understand Bank of America doesn't really have much exposure in Russia in that sense. But more broadly, do you expect the enormous risk we're seeing? Certainly this war brings it home to all of us. This is a thing that I think most of us never thought we'd see in our lifetime. But you also have supply chain issues. You've still got COVID-19, particularly over in China. Do you think that might affect the stress tests? Do you think they might be tougher this go around?
Well, we've already submitted them, and we do those scenarios all the time. And so the scenario baked, largely it gets back, and you can see the variables are published, to an unemployment rate as high as it's ever been, 10, 11%, 10% plus, to a drop in the market, to a drop in the real estate markets. And frankly, how you get there can be a little bit different depending on some things, but mostly it's that the impact on that is through the core credit portfolios in terms of consumer credit, commercial credit, a little bit of counterparty losses under the stress test scenarios. So that you can see, and we've had strong capital, and our losses are lower than anybody else in the industry across the last 7 or 8 stress tests. So even though the scenario changes, the outcomes, the outputs, the variables used end up being slightly different, but around the same. More importantly, at Bank of America, under our responsible growth, we manage our business to both grow, no excuses, and do it the right way on the risk. And so what you've always seen is we're running stress tests on our own portfolios of higher inflation. What could that do? And there's some things that are fun and some that are not so fun, but we run it all the time to make sure we have the capital liquidity to withstand it.
Brian, let's come back to your first quarter earnings here very specifically. As I say, you had a very strong quarter. No one would deny that. Tell me what your highlights are. And let me start, for example, with deposits and with particularly loans. Are you growing loans the way you want to? Because that has been a struggle for all the banks in the recent past.
Yeah, I mean, year over year, we grew our loans, 10% or so, 13%, 14% commercial, 4% in consumer. Consumer's still catching up on the loan side, quite frankly, largely due to the huge refinance in mortgages that just barely is breaking through now. And the second was, card balances got paid down. We had 90-odd billion before the pandemic. We have 78 billion or so now. And so they started actually growing, and they stayed up higher on a relative basis and a seasonal basis. So we feel good about the loan growth. Loan growth at 10% is one of the better in the industry. The deposit growth year over year was $240 billion, David. I mean, think about that. That's a good-sized bank, and that's just core to the great job the team does in terms of working with clients and more clients doing more with us. And so that drives our engine room, as we call it, our balance sheet, and that's where we make our money. And then on the fee side, investment banking fees were down because underwriting stuff. We had strong advisor fees. The trading team was down a bit. Equities was a record. Best trading first quarter, other than last year for many first quarters that Jimmy DeMar and the team does a great job. So we feel good across the board, but we grew revenue, which was unusual, and we brought down expenses, which was also unusual, and that then led to operating leverage for the third quarter in a row. We had 20 quarters before the pandemic, and that operating leverage is what is a statement about how our company can both grow revenue and manage expenses well. Yeah,
I want to come back to those expenses because I know you've always taken pride in that, but before that, you mentioned equities trading. Are you taking market share, and particularly, do you think you're benefiting from some of the struggles that Credit Suisse had with prime brokerage?
We won't actually know that until all the companies report and our team can calculate, because right now you're working off the best in the business. The few competitors that reported so far report early, and then we'll see everybody play out. But over time, we've been gaining share against the market in fixed income and equities. But we'll ebb and flow of, commodities was a big product this quarter. That's not our biggest business, what they call a macro businesses. The more credit related, where we work with our investor customers and our commercial customers in the issuing market, that was depressed a little bit this quarter. That'll come back, and we'll make some more money there. But Jimmy and the team do a great job. We've expanded that business, and they've done. But remember, we're a balanced company, and because you're in the 212 area code, David, everybody talks about trading or that. The reality is that, the consumer business and the global banking businesses, loan lending and deposit taking and global transactions had great quarters in our wealth management business. The team, Andy and Sieg and Katie Knox, run that. I think, their revenue is up. Merrill revenue is up like 10% for the year over year, which is very strong performance.
One of the things we've heard a lot about is the battle for talent, if I can put it that way. Is that easing up any because there's a little bit less deal flow, isn't there?
Yeah, it's the attrition. If you look at our company, 19, our attrition, we put it right in our annual report, was around 11, 12% or something like that. And then it dropped in half in 20 because who was going to quit and try to find another job in 20. And then it went back up in 21 about to where it was, maybe 50 basis points. It's running about that level, 12, 13, which is not 12% or so, plus or minus. It's the high volume jobs where it happens in, the call centers and branches and things like that. In terms of talent in the investment banking or trading or commercial banking stuff, we're stable and we're adding new entries into financial advisors. So we feel good about it, but it is a constant amount of work that has to be done to make sure you have a great company with great compensation, but great benefits, and also, a great other parts of what we do, how we do the business, our diversity and inclusion activities, our ESG activities, our employee networks. These are all important things to our team, and that's what we're working on also.
Brian, you mentioned how well balanced your bank is. You have so many fingers in so many different pies. What about the crypto pie? We have a new mayor, as you know, in New York City who really likes crypto a lot. Is there anything Bank of America can do or wants to do to compete with some of the other institutions that are participating in crypto these days?
We have a very limited ability to do anything just because the regulatory structure around banks is just different. And so our research team writes on crypto and crypto-related companies, because they can do that because it's not we do a very limited activity on futures and stuff. But there's really not a lot we can do in the way you're thinking about it. So our Merrill Edge is growing nicely every year. It has nothing to do with crypto, as other sort of online brokers or digital brokers may have. And it's just not allowed. And we'll have to see how the regulatory process emerges.
Brian, let's come back to the controlling costs, which you've taken pride in throughout your tenure at Bank of America. Part of that, I think, has to do with closing some branches. And I know you open some, you close some, but net, you're closing branches. And my question really is, what are you doing about the unbanked and the underbanked? I wonder if some of those people aren't in the areas where you might be closing branches.
So I think if you step back from what goes on with us, goes on with any capable retailer in the world, which is you're always shifting your physical footprint and your digital footprint to make the business work better. And so, yes, we're down branches because customer behavior has changed massively. But on the other hand, when we look at where those branches are, we're deploying more branches and we're rehabbing branches. This year we'll put out 200 or 300 new branches and we'll rehab almost 1,000 of them, and that just keeps bringing forward to what the customer demands. Now, what we look at in low and moderate income neighborhoods is our percentage of branches in low and moderate income neighborhoods is as high as it's ever been. We monitor that very carefully, and there's actually rules that require that, CRA and other things to do that, but we do it because it's the right thing to do. And then the question is, how do you impact your community? So we have a Pathways program that we started a few years ago where we hired 10,000 people to work in our branches and call centers and operations from low and moderate income neighborhoods. We completed that in 3 to 4 years. We announced another 10,000. So we're hiring from the communities. We're offering small business service in those communities. We're keeping branches in those communities. And yes, someone may say, branch A, I'd love to be open in perpetuity, but it may not fit the modern footprint. But on the other hand, when you go to unbanked, we have about 3.5 million of no overdraft accounts. We started on this thing called Bank On program. We started a non-overdraft account. We open a lot of accounts for young people across the board. We are ubiquitous out there that people can engage. So we feel very good about what we do for all segments of the income strata, and that's who we are and how we do it. And so we reach deep into what is traditionally called the unbanked or underbanked, and have if you have a direct deposit of $250 a month, you can get a free bank account at Bank of America. That means anybody's getting Social Security on up has a free account here, and we do a great job with those.
So, Brian, this is slightly different, but I think related, because we've talked before about the commitment that you've made to investing in financial enterprises that are owned by people of color. Give us an update on where you are on some of those investments, how they're doing.
Well, there are a couple pieces of that. I think it was three component parts: the minority depository institutions, MDIs, the CDFIs, the community deposit financial institutions, CDFIs, and then there's the private equity funds piece we did. And so all this is to create opportunities. So in the MDIs, we went to all 140 of them that would talk to us. We said, we'll put equity in. We've completed that. That is now largely done. There's a few still working on it, but largely we're through that. So that's done. Step two was to increase our CDFI, because that works in tandem, helping small businesses and other clients. That's up to $2 billion, and that's held strong at $2 billion, even though we put it up there. What we thought was a temporary measure, and we're doing that. But the third and more interesting thing is when we looked at private equity going to minority and women-owned entrepreneurs, it just wasn't, the allocations weren't high. So we said, how do you get that done? So we said, let's go out and survey our market presence in 92 markets around the world, around the country, and say, bring us private equity firms that are run by women, blacks, Asians, or Latinos, and we will invest and help them become better private equity. We've now done 100 of those funds, about $350 million of commitments, and we're continuing to go on that. We'll probably get to 500, and then we'll run through it. Those private equity entrepreneurs then invest into similarly owned companies, women, blacks, Asians, and Latinos, and therefore you have the companies owned, and so that we're pushing money to create opportunity in those communities that haven't gotten private equity before, at the private equity level and at the company level, and then ultimately that'll be at the employee level.
Brian, one of the things that all of us who work in New York City are very conscious of is the return to the office, as it's called. Bring us up to speed on that. I think you have a June 1 deadline, don't you? What is the situation with your employees? I mean, how many are vaccinated? How many are back in the office? Are you wearing masks?
Basically, we have a set of policies by our medical experts. We have 5 or 6 medical experts that we have as a panel. And so the unvaccinated people are returning to office in May 1st, I think, and can come in voluntary before that's in certain areas where we're going. We have health protocols around that, and those will change over time. But the goal was to now at that point, frankly, everybody's been allowed to come back in the office and can come back. And on a given day, we have 100,000 plus people around the country in the office and all over the place. And so it's just a transition to get it all working. And yet at the same time, we're asking our teammates, what'd you learn about the pandemic and how you want to work? And then let's square that up with what we can do as a company. We've always had alternative work arrangements. 5, 6, 7% of our people before the pandemic had different, work from home, different types of arrangements. But it's become a more broad request, and we're looking at that and saying, what's the right set of rules? And it has to almost be by job because of, remember, we have deep pools of customer data, customer information. We have people talk to customers. Things that were tolerated during the pandemic when you had no choice. Customers and the control environments and stuff are a little different examined when you do have a choice. And so we have to square what we can do with our teammates' desires with what we can do from operating the company well.
If it was 5, 6, 7% before the pandemic, if you were going to guess a year, 2 years from now, what do you think it will be?
It'll be higher. I mean, it is higher today. And, but remember, we always had, a huge traveling sales force, for lack of a better term, between our, financial advisors and Merrill and our private bankers and our commercial bankers and our investment bankers and our corporate bankers. They're always out in the field. So it's always a little bit of a misnomer to talk about, working in the office. For guys like me that, I travel a lot, for people in certain functions or jobs more in the office. So it'll be higher just because people's desires have changed. Now we have to square that up with what they're doing and how they're doing. And, it's good for mentorship. It's good to see kids back. When I was in One Bryant Park yesterday, there's a lot of people moving around the elevator banks and around, and that's good news. And here in Boston, where I am today, again, the commute times are gone back up to 45 minutes from my house into town. So that means it. In Charlotte, when I was walking downtown, earlier this week for earnings, you saw people moving around, and that's all good news for the downtowns across the country.
Brian, finally, I'm mindful of the fact you're a very big bank. You're also a very big employer with issues for a lot of employees. And one of the things that employees, certainly around New York City, are concerned about is safety and crime, because there have been so many instances, including the shooting in the Brooklyn subway. But goodness knows it's been all around the country. This is part of what Mayor Eric Adams had to say on ABC's last weekend, about the crime problem.
This is a national issue. It's not a red state, blue state. In fact, red states experience a higher murder rate than blue states. Tulsa is 3 times the murder rate of Los Angeles. Mississippi, Kentucky, Louisiana.
As a CEO, as an employer, I know you've always been very concerned about your employees. Is this an issue in the workplace, whether it's in New York or Boston or Charlotte or out in rural areas for you? Are employees concerned, particularly about taking public transportation?
It's always an issue, both here and around the world, whether it's in London or whether it's other places. And you can remember in those situations, including the most recent one you mentioned in Brooklyn, are just horrible situations that, people getting killed and people putting in fear and causing the question, those types of, can I move around safely? And, as a father with kids in New York, you and I would worry about these things. And so what I always say to mayors when they talk about, job locations and keeping people in towns and stuff, around the whole country and world is a simple thing. You got to have good housing, you got to have safety, good transportation, and some culture. And if you do that, kids will love to live there. And look, kids love to live in New York. And we just brought 2,000 in. We will be bringing 2,000 in here in a few months to, for our summer kids and our next set of permanent hires. And when we called the 5,000 or 6,000 back over the last 3 years, they were eager to get back. So it's a great city. But the mayor's working on the problems. But it's not unique to New York City. Every city has to have those 4 or 5 basic elements to be a great city. And those cities that do well at them are end up with great population growth and success.